Welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and I'm thrilled to have Victor Haghani on the show today. Victor began his career on the fabled Salomon Brothers bond desk back in the 1980s. He became an MD on John Meriwether's bond arbitrage group before co-founding hedge fund Long-Term Capital Management, where he had a front row seat for its rapid rise and eventual demise. A graduate of the London School of Economics, Haghani also has served as a senior research associate at LSE's Financial Markets Group, and in 2007, he launched Elm Wealth to apply his research in real-world investing. His insights have been featured in The Economist, The Wall Street Journal, and Bloomberg, and he's delivered TED Talks on investor psychology and financial strategy. I have so many questions for Victor, but my burning ones today are for his book, The Missing Billionaires, one chosen by The Economist as one of its best books of 2023. So welcome to the show, Victor.
Oh, thanks so much, Mike. Great to be here.
So the burning question number one, what are the missing billionaires?
Well, the jumping off point of our book came from a TEDx talk I gave more than 10 years ago, where I was trying to illustrate the difficulty of making sound financial decisions over long periods of time, over a lifetime, which is really what we have to do these days. There's really, very little in the way of defined benefit pensions out there. So, our retirement is mostly in our own hands, all around the developed world. And the puzzle of the missing billionaires is really this simple observation that in 1900, there were lots of wealthy families in America. Over 4,000, according to the U.S. Census in 1900, had more than $1 million. And $1 million growing at the stock market's return of 10% would have turned into like $160 billion. The U.S. stock market, this is $160 billion by today. And even if you hit that return by 2%, let's take 2% off of it so that we can account for people spending their wealth, paying taxes on what they spend, or even some part of that could be underperformance relative to the stock market, that you still get $1 million turning into like $16 billion today. Let's say that each of those families had children at kind of an average rate. Of course, some would have had more and some would have had less. Some would have passed the money down to the eldest child. I mean, there's all kinds of things we could talk about with this. But in the simple case, each one of those families in 1900 would have about 16 descendant families today that should all have $1 billion, on average. Even, at this 8% return, 2% below the 10% return. And when we look at the list of billionaires in America today that is compiled by Forbes, we're hard pressed to see anybody on there that is where their wealth is descended from one of those families in 1900. So, all of those families or hit some kind of bumps in the road where they weren't able to maintain the level of wealth that they had in 1900. And, it's 4,000 times 16 is 64,000. We're not saying, oh, well, we should see 64,000 billionaires and we only see coming from those guys and we only see 20,000. So, wow, no, I mean, this is a crazy thing. I mean, there's not one that we know of. I mean, maybe there's one, maybe there's 10. And of course, not everybody could have done it. The world would be different if they didn't invest and spend the way that they did. But it really just, to me, is such a strong signal of how difficult and challenging it is to invest and spend wisely, to make sound financial decisions over a lifetime. That, boy, is it tough, is what that indicates to us. And that's a jumping off point for our book, where we tried to help people to understand and adopt tools for better financial decision making.
That's right. So the book covers the landscape there. It really serves as a general resource for investors wanting to understand a little bit about all options that are out there. But at its core, it's really about risk management and sizing bets. So what did you conclude there in terms of what would serve investors best?
So, in the book and whenever we talk about it, investing can be thought of in a nice way as involving two decisions. What is it that I want to own? What do I want in my portfolio, and how much, right? There's a what or a selection decision, and then there's a how much decision. And, we've observed that like 99.9% of the discussion that we see in the financial media, in all over the place, is really about the what. What should we own? What should we be worried about? Should we be worried that Nvidia is too big or has too high a PE or whatever? And not enough attention goes to this how much question. And they're equally important. I mean, that if you choose good investments, but you size them incorrectly, you can go bust or you could have too little benefit from them. So the how much decision is as critical as the what decision. And it's an easier decision too, because you just need to get it right for yourself in your own circumstances, your own risk aversion. Whereas the what question, you're kind of competing against everybody else. I mean, you can make a decision to not compete against other people to some extent by going into index funds, which we think is a great way to go on the what question. But, the what question in its broader sense, if you're thinking about all the options out there, is a really tough one. Again, we talk about the what decision just a little bit in the book because we don't talk about it more because everybody is talking about it. And all good personal finance books talk about it, and so we didn't feel we needed to go so much into it. So we have a chapter devoted to that, but the rest of the chapters are all really about sizing. And we think that we think the best solution to the puzzle of the missing billionaires, or the best explanation for the missing billionaires, is poor sizing decisions. That we think so many of these families wound up taking too much risk that was idiosyncratic by being in concentrated portfolios. The Vanderbilts stayed in railroads and transportations until they dissipated all their wealth, and their main holding company, I guess, went under in the 1950s or something like that. And, you know, that these wealthy families have a tendency to stay in concentrated portfolios and thereby take a lot of idiosyncratic risks that, we believe should not, that theory and practice believe should not get compensated. It's only systematic, undiversifiable risk that should get compensated. And
That's interesting, Victor. If I could cut in for one quick
yeah, yeah.
sec there, is just
Sorry, going a little
the
long there.
oh, no, not at all. And I'd love for you to continue explaining the thesis and the findings from the book. But just one thing that we encounter sometimes with advisors out there will encounter, which is folks who generated their wealth. They generated it by concentrating the risk in one thing. They built a business, say, and they sold it, or they built it very large and it kicked off a lot of cash flow. And then they maintain that perspective on risk thereafter, where they're like, okay, well, this is what made me rich, but it's maybe not really what's going to keep you rich. Is to your point? It's just there needs to be a switch in perspective on risk taking at some point in the line if you want to preserve that long term.
Yep. Yeah, exactly.
One of the things that I really enjoyed throughout the book is you return to this coin flip scenario. And I love it just because it's fun for me as someone who's worked in the financial services for many years to think about people in our seats doing this and doing it badly. Talk about the coin flip game, or what scenario, whatever you called it in the book, but and what it showed you about people's understanding of risk and return and how to size bets properly.
So, that with this missing billionaires parable, we had this notion that people really weren't thinking enough about sizing. So we decided to run an experiment to try to test this out a little bit and see if people had either an intuitive or a trained approach towards risk taking and bet sizing. So we conducted an experiment where we let people flip a coin, and digital coin. We told them we had programmed to land 60% of the time on heads, which we did. It wasn't a trick question or anything. And we gave them some money. We gave them $25, and we said, you could keep flipping this coin and bet as much of your bankroll as you want on each flip. And at the end of a half an hour, we'll give you however much money you've grown the $25 into, subject to a cap, which if you get close to the cap, we'll let you know what it is. And the cap was $250. And, it's a really simple thing that one should do. And when you think about the strategy, it's a pretty simple one to maximize your chances of getting lots of money from us. It's flip it fast, bet on heads every time, and bet some rough constant proportion of your bankroll on heads every time. And, you should bet something in the 10 to 20% range is kind of the optimal amount to do. And all of that seems super intuitive as soon as somebody tells it to you. But when you're given this game to play and you haven't thought about it before and you haven't been taught about it before. And by the way, all of the subjects for these experiments were either young people in master's programs in finance at prestigious universities or people working on Wall Street. And the performance was terrible. People didn't do well at all. People did really weird things. And very few people, we gave exit interviews, and very few people had ever heard of bet sizing, were ever taught it. And then we went and looked at the curricula of finance programs, and we noticed that it wasn't being taught anywhere to a large extent. I think that things have changed a little bit now. I think we ran this experiment like 10 years ago, and it's been popular, and we wrote it up in the Journal of Portfolio Management. So, I think it's getting more onto the curriculum, but not enough for, I think that making financial decisions under uncertainty is just not taught enough. And, it's like, even if it were taught in masters in finance programs, that's not enough. Like that's even not even nearly enough, right? Even if it were taught there, that's not enough, because how many people do that? That
It should be taught in
it's
home
not.
ec in high school.
Yeah, I mean, it should be taught all over the place, and it should be covered in books. And so we wrote a book to put it in there. But our book is still not popular enough, or it's not for a broad enough audience. And I think maybe we'll try to, I don't know, maybe we'll try to write something that's a little bit more accessible than that book that we wrote to try to fill the gap. But when you read the great books on personal financial decision making, right? Like when you think about which ones are really written by, people with their minds and hearts in the right places, and you think about those books, maybe it's, Bogle's Common Sense Investing, or maybe it's Malkiel and Ellis, or whatever, or maybe, I mean, I think that you and I, we would agree on a dozen of these books, and none of them touch this topic. And the reason that they don't, I believe, is because they are writing to this broad audience in America or in the developed world where financial literacy is woefully low. And so they feel that they need to focus that message on just a few things in those books. And so, I think that we need to, have some books and some material out there for people after they read Common Sense Investing by Bogle. That's the next thing, because once you've read Common Sense Investing by Bogle, or if you've read The Four Pillars of Investing by Bernstein, you're kind of done. Like you don't really need to read the next one, because we agree on these ideas and all of them do a great job of it. We need the next book, to graduate into. We need the next thing. And, I don't know if we'll do it, but hopefully there'll be more of those too, for the people that want more and don't want to just go laterally.
Yeah. Yeah, and to be fair to the folks on there, and to your point as well, there is math involved in understanding what that optimal window is. The three said 10 to 20%, but it depends on what the odds are that you're working with, the 60-40 or a 70-30, and there's a bit of math that's required to do that, but it's a great starting point in terms of the book. I enjoyed it, and don't be too hard on yourself, Victor. It was a very approachable book. I enjoyed it. There is some math in it. There's a little bit of algebra or Latin in there rather, but not too much. And it really covers the landscape. I mean, I was making notes kind of throughout it, and I've got a few peppered in here that I'm hoping to get to today. But one of the things that I was really surprised at, and forgive me if this is retreading similar territory to what we just talked about, but it was amazing to me, this another experiment that you guys did, and I think you won an award for the paper you wrote up on this, as well as on the crystal ball experiment. What lessons from this study should professional investors take to heart?
So we did this experiment. We called it the Crystal Ball Challenge, and it was inspired actually by a tweet by Nassim Taleb, where he said, "Give a person the newspaper one day ahead, and after a year he'll go broke." And we thought it would be really cool to test that out. So what we did was we ran this experiment where we basically gave people the Wall Street Journal a day ahead, let them trade on prices from the day before, and then closed out the positions, after the next day when the news happened. and let people trade with leverage in stocks and bonds, trying to take advantage of getting the news a day ahead. And we chose the newspaper days to be ones where stuff happened, like not just days when there was no news, but we chose, I don't know, a third of them were from employment reports. We went random, like we didn't try to find days when employment was strong and bonds went up or something like that. We went randomly, but we chose from days when there was stuff going on and when markets were volatile. And we've had tens of thousands of people now play this game on our website. I haven't tracked how people have been doing over time, but to begin with, we played it for money. We gave people money and let them play, and we were going to pay them, and we did pay them for how they did. And it's really humbling. It's very difficult to like get super rich from having the newspaper a day ahead on 15 different days. And, I think that's the most amazing thing, is that sometimes, the news comes out and it's like, this is what I think is going to happen. And the exact opposite happens in a big way. It's just very hard. And I think the lesson there, we were also looking at how do people make sizing decisions and things like that. But I think that really one of the fun lessons from it and powerful lessons is just like, don't that it's that even if you have the newspaper a day ahead, you're not going to do that well. So don't try to, don't make investment decisions based on some near-term reading of the economic or politico-economic tea leaves. Because even if you had a crystal ball, you probably wouldn't do great from that. That there's some other ingredients for success there which are harder to come by even than that.
Yeah, you never really know, do you? What how a market's going to ingest certain news, whether it's macro or microeconomic. Really, at the company level, it's always a bit of a crapshoot, isn't it?
Yeah, yeah, it sure is.
So you referenced it earlier when you said you didn't get into sort of security level analysis, and it's more of a like using index funds, ETFs, to build a portfolio. And I want to sort of build on that theme a bit because it was something that you covered a lot in the book, which is kind of how to apply this sizing to the average portfolio. And so I wonder if you could talk a bit about enhanced indexing and kind of what your takeaways were around how listeners to the show can really apply this in their day-to-day to help improve how they're managing their portfolios.
Sure. So, at the core, our risk taking has to be a function of expected return and risk. So if I give you a 60-40 coin, the 60% chance of landing on heads, and let you bet on it, or I give you a coin that's 70% chance of landing on heads, you should bet a different amount of your wealth on those two coins. The 70-30 coin, you should bet more. You should bet twice as much, actually, because the expected return is basically twice as much and the risk is about the same for each flip. And so that's at the basic level, how we should think about risk taking in our investment portfolios. Now, there's the what question. What to invest in is has a relation to this, in the sense that I only want to invest in things where I can come up with an expected return that makes sense to me. So, it's hard for me to want to have oil in my, even though I think oil is this huge asset class. $100 trillion or more of oil reserves, even at a discounted per barrel price, are out there, and it's owned by people. Ultimately, it's owned by us. And so it should have a risk premium, but I can't see what it is. I don't have any cash flows to really go on. I just don't know what that risk premium is. And so, it's like, well, how am I going to invest in it if I really don't know what the expected return is for that? And so one thing for me is I want to invest in things that should have a risk premium in terms of the risky part of my portfolio. The safe part I want to be safe. But for the risky part of my portfolio, I want to invest in things that should have a risk premium because they're big and they have undiversifiable risk. And I want to invest in things where I can estimate the risk premium, and also where the fees are low and where I'm not taking a lot of idiosyncratic risk in the whole process. So that takes me to low cost, broad market index funds as the building blocks of my portfolio. Then I have to estimate their expected return, and I have to think about the risk. I might think about the risk simply as high risk or low risk, for instance, or I might be more I might try to be more precise than that. And I have to bring in my level of risk aversion. So, one way I could do it is I could use, I could try to build things up, in some way using, a utility curve that captures
Hmm.
my risk aversion. But I don't need to do that. I can just do it much more easily than that. I mean, one way that I can do that is I can just say, how much equities do I want in my, let's say I get to this point, or you agree and you come to the same point where I am, where I'm just going to invest in equities and fixed income. That's it. I'm going to invest in government bonds and the global equity market. Those are my building blocks. That's what I'm going to build my portfolio out of. And I'm thinking about my asset allocation now. So I might start off and just say, well, how much do I want in equities if we're in a world in which equities have an expected return that's, say, 4%, but it could be anything, at
Hmm.
4% more than safe government bonds. If I think that equities have an extra 4% return, and let's say the riskiness of the market is at like a normal level. It's not high risk like in the COVID period in early 2020. It's not like super quiet like it was in the first half of 2017. I don't know why it was so quiet then. It was just particularly peaceful, but it's kind of normal in between, something, like the way things are today, maybe, or maybe a little bit less volatile than, the way things were a couple weeks ago.
Yeah,
It's like, okay,
yeah.
in
Assuming
that
that, yeah,
world.
assuming that this quiet is not quiet before the storm, but we'll see about that.
So, how much equities do I want to hold in that case? And that really is answering this question of risk aversion. It's also kind of answering a question of how risky do I think stocks are, because I'm just saying normal riskiness. And I just need to answer that question as a starting point. And once I do that, I'm not saying that it's ever the case that equities offer 4% more than safe assets. I'm not saying on average in the past it was that. I'm just saying I need to ground my portfolio somewhere. So I just arbitrarily pick a number: 4%, 5, 7, 2, 3. It could be anything.
So you'd be 60/40 if you got a 4% equity risk premium. That's your baseline.
Yeah, and then you say, where do I want to be? And each person would answer that question somewhat differently. So for me, I would probably say I want to be 75 to 80% in equities in that world.
Mhm.
Okay. So now I'm almost home. I'm almost finished now, because now all I need to do is I say, well, if that's where I want to be at 4%, where do I want to be if equities are offering 6%? Where do I want to be if equities are offering 2% more than safe assets? Where do I want to be if we're in a high risk environment? Where do I want to be in a low risk environment? And I just need to write those things down. I can interpolate if I want between them. And of course, then I need to come up with, where are those estimates? And there's lots of places to get those estimates from. I could get those estimates from a consensus of 20 leading financial institutions and investment managers and average their capital market assumptions together for the long-term expected return of the global stock market. I could just, what we do is we think earnings yield, cyclically adjusted earnings yield, we think is a good estimate of the long-term real return of stocks, and then compare it to a safe asset return of the real yield of some long-term government bonds.
Mhm.
And that's it. That's your expected return, your expected risk premium for equities. Now you've got that number. And then for the risk, you can just, like what we like to do is we just say, are we in a high risk environment or a low risk? If we're in a high risk, we're going to cut exposures by a third. If we're in a low risk, we're going to increase exposures by a third. But you could do that lots of different ways, and it's all about the same. You just want to cut back when risk is really high. And
So risk is just volatility, like VIX measures and
yeah, I mean, you could use VIX. I
sentiments
mean, yeah, you could
indicators, or
use you could use whatever you. I mean, all of the risk measures point the same way when we're in a high risk environment and low. There's not a lot of ambiguity, but you could go for a mix of measures. It doesn't matter. I mean, the main thing is when, risk is high, you want to run stuff lower. You want to run less equity risk, I think, less equity exposure, and when risk is high. And you could call that vol targeting, and that's a sensible way to do things. But you need to be disciplined. You need to have a set of rules, and you need to do it. And I just think that a static asset allocation to me is just like an abrogation of duty by anybody that's doing that. I mean, it just makes no logical sense whatsoever to just have the same asset allocation, whatever is the expected return and risk of your risky portfolio. I mean, I don't know how we got to this place where that is like the default thing that everybody's doing. I mean, not only is it Not only I think is it suboptimal for everybody to be doing that, but it also I think is giving us a lot of market-wide problems too. The fact that nobody wants to think about the expected return of the stuff they own is quite remarkable.
So Victor, you're describing it in the world that I've operated in for my career. It's we talk about strategic asset allocation, and then maybe you do some tactical stuff at the margin, right? So you're on 60-40 on equities, and if you have a strong view on equity returns relative to bonds, maybe you go overweight equities. You move the target to 62-38. But historically, I mean, it's always a tough one. And in firms that I've been at, it's always tough because asset allocation, whatever you decide to do with that, is the biggest lever. It's going to have the biggest impact on performance, and it cuts both ways. So I've always found that there's a lot of conservatism around how far away from what sort of down the fairway, your original sort of base case scenario that all the portfolios are based on, whatever that strategic asset mix, which is how would I do when things are sailing normally, and then try to maintain the perspective on that. But I guess what I'm trying to ask is, like, in your world, do you deviate quite widely then from that kind of base case when you're allocating, or is it still within like a couple percentage points in a sort of say a 75-25 scenario? Would you go plus or minus 10 or 15% from that, or how wide would you go?
So in our separately managed accounts, we leave it up to every investor to decide how dynamic they want to be. But we tell them that 100% dynamic and the dynamic that we do for ourselves. So first, we also let them they have to tell us what they want in their baseline. So they might say, I just want 50% equities if the expected return is 4% over safe assets. But if we take somebody that's typical baseline portfolio of one of our investors is like 70-30, that they want 70% in equities if equities are offering an extra 4% return relative to safe assets and risk is normal. And then we say to them, well, if you want us to be 100% dynamic, which is how we've been doing things, your equity exposure could go anywhere from 0 to 100. And if you want us to be 50% dynamic, then your equity exposure could theoretically go from 35 to 100. So really very dynamic, very, and most of our investors are kind of at 100% dynamic. We have an ETF, the Elm Market Navigator ETF, which is 100% dynamic. Now, having said that, we've never been in an environment where we would have had zero in equities, but the rules that we have would allow for that. The lowest equity exposure we've had in our portfolios over the last 15 years or so, has been like 40%. But we've been pretty close to 100% at other times. We've been at 100% at other times because we have a leverage constraint that doesn't let us go above. So we've been pinned at 100% many times over the last 15 years. So yeah, it's not 1 or 2%, and 1 or 2% just doesn't make any sense to us. That if you believe that U.S. stocks, for instance, if you believe that, if let's say that you're only investing in U.S. stocks, you don't have international diversification. And if you look at U.S. stocks, how can you believe that U.S. stocks have a higher expected return versus fixed income than a couple percent? Nobody, like virtually nobody believes that. I mean, some individual investors believe that, but 20 financial institutions out there, basically none of them believe it, from Vanguard to BlackRock to Goldman to PIMCO, whoever. That's what they're all telling us for the next 10 years is that stocks have an expected return, no more than a couple percent more than safe assets. And the average of them is less than 2%. So that's really different than the way things have been at other times in the past. How can you have the same asset allocation when US equities are offering 1.5% more than bonds over the next 10 years than versus a time in 2010 when they were offering 6% more than safe assets? It makes no sense.
Hmm. Yeah, because rates were lower and then markets were in the toilet, right? Yeah.
Yeah, it makes no sense. And risk, I'm talking about 2010. We came out of the financial crisis. Markets were not super volatile. They were docile, similar to today. There's always a risk around the corner of a problem, but they were pretty normal. They were normal level of risk, but they were offering a lot more relative to safe assets than today. By a lot, not by a little.
Hmm.
How can you justify that same asset allocation? I don't understand how we got here. I think that there's this confusion between stock picking and dynamic asset allocation where people equate the two things. It's like, "Oh, I believe that stock picking."
Well, I think it's benchmark risk as well, right? Especially for institutional investors, right? If they
But
if
what benchmark? It
well,
doesn't
that yeah,
make
that's
any
the question.
sense. It
Yeah,
doesn't make any sense.
the consultants require you to be held to a benchmark, so that's how they end up getting married to it. I think is the
But
problem.
it's all circular, it just makes no sense, right? I mean, it's like somebody told you that you have a benchmark, it makes no sense. I mean, that investing has to tie back to expected return, risk, and risk aversion. There's no alternative. You can't avoid that logic. There's no place to hide from that. And yet, that's what we're doing.
Yeah. So I can't have you on here and not ask one question about LTCM. So if I, maybe you could briefly describe. I mean, we're already a bit over time here, but I would love to hear just a little bit from your perspective, your experience with long term capital in terms of. You don't need to go through everything that happened. Most of the listeners on the show will remember. But how did that experience inform your last, I guess, 27 subsequent years in the market, and as well as writing the book?
Well, I guess, one thing I felt was that, after I reflected on the experience and, I kind of wish that instead of somebody giving me the reminiscences of a stock operator to read when I came to Wall Street in 1984, that they had given me something similar to the Missing Billionaires book, or they had given me those ideas, not that book, but given me those ideas. Those ideas all existed from the 1960s, late 1960s.
Hmm.
And I wish that I had been taught those ideas and that it had been impressed upon me how important they were. So, I think that looking back on the experience, yeah, I feel that, that's the one thing that I kind of wish is that I had had a greater appreciation for these ideas of investment sizing and, particularly making better personal financial decisions. When you're running money in a strategy, there's a risk of loss, and so investors in our fund knew there was a risk of loss. We knew there was a risk of loss, and things went really well, and then things didn't go well, and that's just investing. If you're going to try to invest in certain kinds of strategies that people hired us to do, that was that. I think there's other more micro lessons that could be useful to hedge fund managers, but the really important lessons for investors, for individual people, is more to do with how I made decisions about how much of my savings and compensation and all of that I kept invested in our business. A greater appreciation for bet sizing, for investment sizing would have led me to a different decision at the time. And so I think that's really the most valuable lesson from LTCM that is not so widely appreciated. The books that were written after LTCM, they were written in a hurry. They were written without reflection, which, okay, there was demand for the books. So authors wrote the books as fast as they could, but they didn't do justice to the lessons that became more apparent with once a bigger amount of time had passed and people could reflect on things. And I think that's really one of the big lessons was around individual financial decision making.
Yeah, my own recollection of that time is it was formative for me because I was actually just a cub analyst. I was in wide-eyed Canadian in New York. I was out there for the analyst training at Merrill Lynch that summer of '98, and yeah, so they had all the TV stations going, and the Russian Default happened, and things were happening with LTCM, and it was a lot going on at the very beginning of my young career. But
Well, you made it through. That's great.
I
And
made
here
it
you
through.
are.
I'm still here, and so are you. So fantastic. Well, Victor, usually I ask our guests a two-part question at the end of each interview, but I feel like you've answered it when you talked about your reflections on LTCM, which was what key piece of advice would you offer yourself is to focus on bet sizing and understand risk outside of just what, but also how much. So We'll leave it at that. I've been speaking today with Victor Haghani, founder of Elm Wealth and author of The Missing Billionaires. Thanks so much for coming on the show today, Victor.
Thanks, Mike. Great to be here.
I'm Mike Wallberg, and this has been The Enterprising Investor.